Your Social Security check is about to get bigger, officially confirmed by the Social Security Administration. Starting January 2026, 75 million Americans will see a 2.8% increase in their Social Security and SSDI benefits. This isn't speculation or rumor. This is the real cost of living adjustment that's already been calculated and approved. Here's what this means in actual dollars. The average retirement benefit will rise by about $56 a month, from $2,015 to $2,071. For disability recipients on SSDI, the average monthly payment jumps from $1,586 to $1,630. That's an extra $44 every month. And if you're receiving supplemental security income, the maximum federal payment increases from $967 to $994 for individuals. But before you start budgeting that extra money, there's something critical you need to understand. Medicare. Part B premiums are climbing from $185 to $202.90, a 9.7% increase. That means if Medicare comes out of your Social Security check, your actual monthly increase might be closer to $26 after the Medicare deduction. This is the reality that 77% of older Americans say won't be enough to keep up with rising prices, according to recent AARP research. Beyond just the payment increase, there are other changes hitting in 2026 that could directly affect your benefits. The earnings limit is changing, the substantial gainful activity threshold for SSDI recipients is going up, and there are new rules about how much you can earn while still collecting benefits. In the next few minutes, I'm going to break down every single change coming your way. The exact dates your payments increase, how to check your new benefit amount before it arrives, and the strategies you can use to maximize what you actually keep in your pocket. This is information the Social Security Administration has confirmed, and you deserve to know exactly how it affects you. Now, let me explain something that a lot of people don't realize about this raise. When the Social Security Administration announced this increase, they weren't just throwing out a random number. This adjustment is based on the Consumer Price Index for urban wage earners, which tracks the actual cost of goods and services from July through September. The government measures everything from grocery prices to rent to medical expenses during that period, and then they calculate what it takes to keep up with inflation. The result this year was a determination that benefits needed to increase by exactly 2.8% to maintain purchasing power. What makes this year particularly interesting is that we're seeing a smaller increase than what we saw back in 2022 and 2023, when inflation was running much hotter and retirees got adjustments over 8% one year and then 5.9% another year. The smaller increase this time around tells you that inflation has cooled down considerably compared to those peak years, but it hasn't disappeared. Prices are still going up, just at a slower pace than before. For someone receiving the average retirement benefit, that $56 monthly increase works out to $672 more over the course of the entire year. For disability recipients getting that $44 boost, you're looking at $528 annually. Those aren't life-changing amounts for most people, but they do help offset some of the rising costs you're facing at the grocery store, the pharmacy, and everywhere else. Here's where things get complicated, though, and this is something I really want you to pay attention to because it affects the majority of Social Security recipients. Most people who collect Social Security also have Medicare, and their Medicare Part B premium gets deducted automatically from their Social Security check every single month. Right now, in 2025, that premium is $185 per month. Starting in January 2026, it's jumping up to $202.90. That's an increase of $17.90 per month, or nearly 10%. When you do the math, if you're getting a $56 increase from Social Security but losing an extra $17.90 to Medicare, your actual take-home increase drops to about $38 per month. For disability recipients, the math works similarly, leaving you with maybe $26 or $27 more after Medicare takes its cut. The reason Medicare premiums are going up so much has to do with projected increases in healthcare costs and utilization. The Centers for Medicare and Medicaid Services looked at what's happening with medical spending, including hospital services, doctor visits, and prescription drugs, and they determined that the Part B program needs more revenue to cover those rising costs. There's also something called the Part B deductible, which is the amount you have to pay out of pocket before Medicare starts covering your expenses. That deductible is going from $257 in 2025 up to $283 in 2026. So not only are the premiums higher, but you're also responsible for more upfront costs before your coverage kicks in. Now, there is something called the hold harmless provision that protects certain beneficiaries from seeing their Social Security check actually decrease because of Medicare premium increases. This provision applies to people who have their Part B premium deducted directly from their Social Security payment and who don't pay the higher income-related premiums. What hold harmless means is that your Social Security check can't go down from one year to the next solely because of Medicare premium increases. If your cost of living adjustment isn't large enough to cover the Medicare premium increase, the government will limit how much they can deduct from your check. The experts estimate that roughly 1 million Social Security beneficiaries will have their Medicare premium increase capped this year because of hold harmless. However, this protection doesn't apply to everyone, and it only covers the Medicare Part B premium, not other deductions like Medicare Advantage plan premiums or Part D prescription drug coverage. Let's talk about the earnings limits, because this is where a lot of people get confused and sometimes end up in situations where they're surprised to find their benefits have been reduced. The Social Security Administration has something called the Retirement Earnings Test, and it applies if you're collecting benefits before you reach your full retirement age and you're still working. The way it works is this. If you earn too much money from work, Social Security will temporarily withhold some of your benefits. The key word there is temporarily, because once you reach full retirement age, they'll recalculate everything and give you credit for the months when benefits were reduced, effectively raising your monthly payment going forward. For 2026, the annual earnings limit for people who are under full retirement age for the entire year is going up to $24,480. That breaks down to $2,040 per month. This is an increase from the 2025 limit of $23,400. Now, here's the rule. For every $2 you earn above that limit, Social Security will withhold $1 in benefits. So let's say you're 64 years old in 2026 and you expect to earn $40,000 from your job. You've exceeded the earnings limit by $15,520. Social Security will withhold half of that amount, which means they'll reduce your benefits by $7,760 over the course of the year. They do this by not sending you benefit checks at the beginning of the year until they've withheld the full amount. There's a different, more generous limit for people who will reach full retirement age during 2026. For these individuals, the earnings limit goes up to $65,160 for the year, and Social Security only withholds $1 for every $3 you earn over that limit. This higher threshold only applies during the months before you reach full retirement age. Once you hit that milestone, the earnings limit disappears completely, and you can earn as much as you want without any reduction to your benefits whatsoever. That's an important point, because a lot of people think they can never work while collecting Social Security. But the truth is that once you're at full retirement age, your earnings don't matter at all. I want to make sure you understand what counts toward these earnings limits and what doesn't. The Social Security Administration only looks at wages from employment and net earnings from self-employment. They don't count pensions, investment income, interest, dividends, capital gains, rental income, or withdrawals from retirement accounts like IRAs or 401k plans. This is purely about money you earn from working, either for an employer or for yourself. If you're self-employed, there's an additional layer where they look at how much time you're spending on your business. Generally speaking, if you're working more than 45 hours per month, they'll consider you as not retired. If you're working less than 15 hours per month, they consider you retired. Anything in between gets evaluated on a case-by-case basis, taking into account how skilled the work is. Now let's shift gears and talk about disability benefits, because there are specific changes coming in 2026 that affect people receiving SSDI. The most important concept here is something called substantial gainful activity, or SGA for short. This is the monthly income threshold that Social Security uses to determine whether you're able to engage in significant work despite your disability. If your earnings exceed the SGA level, the Social Security Administration may decide you're no longer disabled under their definition, which could result in your benefits being terminated. For 2026, the SGA limit is increasing to $1,690 per month for non-blind individuals. If you're statutorily blind, the limit is much higher at $2,830 per month. These amounts are up from $1,620 and $2,700 respectively in 2025. The increases are tied to changes in the national average wage index, which generally rises with inflation and overall wage growth. What this means in practical terms is that SSDI recipients have a bit more room to earn money from work without risking their benefits. But here's something really important that not enough people know about. The Social Security Administration provides work incentives specifically designed to help people with disabilities test their ability to work without immediately losing their benefits. The most significant of these is called the trial work period. During your trial work period, you get 9 months where you can work and earn as much as you want, and Social Security will still pay your full disability benefit regardless of how much money you're making. These 9 months don't have to be consecutive. They just have to occur within a rolling 60-month period. For 2026, a month counts as a trial work month if you earn more than $1,210. Once you've used up all 9 trial work months, you enter what's called the extended period of eligibility, which lasts for 36 months. During this time, you'll continue receiving benefits for any month where your earnings fall below the substantial gainful activity level. There's also something called impairment-related work expenses, or IRWE, that can make a huge difference in whether your earnings push you over the SGA threshold. These are costs you incur specifically because of your disability that enable you to work. Common examples include specialized transportation to and from work, assistive technology, modifications to your vehicle, attendant care services, and medical devices or equipment you need to perform your job. The way it works is that Social Security subtracts these verified expenses from your gross earnings when they're determining whether you've exceeded substantial gainful activity. Let's say you earn $2,000 per month, which is above the SGA limit, but you have $400 in documented impairment-related work expenses. Social Security would count your earnings as only $1,600, which keeps you under the threshold. The catch is that you need to maintain detailed records with receipts and documentation showing that these expenses are both necessary for you to work and directly related to your impairment. Another thing that can reduce your countable income for SGA purposes is what's called subsidies and special conditions. This applies when your employer is giving you extra help or accommodations that reduce your productivity compared to other workers doing the same job. Maybe you work slower because of your disability, or you require more supervision, or your employer has restructured your duties to eliminate tasks you can't perform. If you can document that your actual contribution to the business is worth less than what you're being paid, Social Security may subtract the value of that subsidy from your earnings. This is particularly relevant for people who are working in supported employment settings or who have employers who are willing to work with them despite limitations. Let's talk about the maximum Social Security benefit, because there's a lot of confusion about this and who can actually receive it. For someone claiming at full retirement age in 2026, the maximum benefit is rising to $4,152 per month. That's up from $4,018 in 2025, reflecting the 2.8% cost of living adjustment. But here's the reality. Very few people will ever receive this maximum amount because you have to meet some extremely strict requirements. First, you need to have worked for at least 35 years and earned at or above the maximum taxable earnings limit in every single one of those years. Second, you have to delay claiming your benefits until age 70 to get the absolute highest possible payment. If you claim at full retirement age, which is 67 for people born in 1960 or later, you'll get a lower amount than the maximum. The reason the maximum benefit keeps going up isn't just because of the cost of living adjustment. It's also because the taxable earnings cap keeps increasing each year. For 2026, that cap is jumping to $184,500, up from $176,100 in 2025. This is the amount of your wages that are subject to Social Security taxes. Anything you earn above that threshold doesn't get taxed for Social Security purposes, and it also doesn't count toward your future benefit calculation. High earners need to understand that they're going to see more money withheld from their paychecks for Social Security taxes in 2026. The tax rate itself isn't changing. It's still 6.2% for employees and another 6.2% paid by employers, or 12.4% total for self-employed individuals. But because more of your income is subject to that tax, you'll pay more overall. Something else that's changing is the amount of earnings required to get a work credit. Social Security uses a credit system to determine if you've worked long enough to qualify for benefits. You can earn up to 4 credits per year, and most people need 40 credits, which equals 10 years of work, to be eligible for retirement benefits. In 2026, you'll need to earn $1,890 to get 1 credit. That's up from $1,810 in 2025. So to max out at 4 credits for the year, you'll need total earnings of at least $7,560 in 2026. For younger workers who are still building up their credit history, this means it might take slightly longer to accumulate the 40 credits needed for future benefits. Now, I want to address something that causes a tremendous amount of anxiety for Social Security recipients, and that's the question of whether benefits are going to be cut in the future. You've probably heard that the Social Security Trust Fund is projected to be depleted in the 2030s, and people worry about what that means for their checks. Here's the truth. Even if Congress does absolutely nothing and the trust fund runs out, Social Security will still be able to pay benefits. The program is funded primarily by payroll taxes from current workers, and those taxes will continue to come in regardless of what happens with the trust fund. The issue is that incoming tax revenue would only be enough to pay about 79% of scheduled benefits, so you'd still get a check. It would just be smaller than what you're currently promised under the law. The reason I'm bringing this up is because it's important to plan your finances with realistic expectations. The most likely scenario is that Congress will take some action before we get to that point, probably involving some combination of gradual changes like increasing the retirement age for younger workers, raising the cap on taxable earnings, adjusting the benefit formula, or increasing payroll tax rates slightly. What's extremely unlikely is that anyone currently receiving benefits will see a sudden dramatic cut. The political reality is that Social Security recipients are a huge voting bloc, and no politician wants to be responsible for slashing benefits for current retirees. But younger workers and people who haven't claimed yet should be aware that the program may look somewhat different in 20 or 30 years. Here's what you need to do right now to make sure you're maximizing your situation for 2026. First, if you haven't already done so, create a My Social Security account on the Social Security Administration's website. This gives you access to your benefit verification letter, your payment history, and estimates of your future benefits. In late November and December, most beneficiaries will be able to see their new benefit amount for 2026 through their online account. The SSA will also mail notices, but checking online is faster. Second, if you're enrolled in Medicare, review your coverage during the open enrollment period and make sure you understand what your total out-of-pocket costs will be, including the higher Part B premium and deductible. Some people might benefit from switching to a different Medicare Advantage plan or adjusting their Part D prescription drug coverage. Third, if you're working while receiving benefits and you haven't reached full retirement age yet, take a close look at your expected earnings for 2026 and compare them to the new earnings limits. If you're going to be close to the threshold, you might want to have a conversation with your employer about your hours or consider deferring some income if possible. Remember that the penalties for exceeding the earnings limit are temporary, and you'll eventually get that money back through higher monthly benefits once you reach full retirement age. But having your checks reduced or stopped entirely during the year can create cash flow problems if you're not prepared for it. Fourth, if you're receiving SSDI and you want to try working, educate yourself about the trial work period, the extended period of eligibility, and what expenses you can deduct as impairment-related work expenses. Consider reaching out to a benefits counselor or work incentives specialist who can help you understand exactly how working will affect your specific situation. The Social Security Administration offers a Ticket to Work program that provides free access to these kinds of services. The last thing you want is to inadvertently earn too much and lose your benefits when you could have structured things differently. And finally, make sure all of your direct deposit information is up to date with Social Security. The vast majority of beneficiaries receive their payments electronically, and this is by far the safest and most reliable method. If you're still getting paper checks, I'd strongly encourage you to switch to direct deposit. It eliminates the risk of checks getting lost or stolen in the mail, and your money shows up in your account on the payment date without you having to do anything. You can set up or change direct deposit through your My Social Security account or by calling the Social Security Administration directly. The bottom line is that 2026 brings a mix of good news and challenges for Social Security and disability beneficiaries. The cost of living adjustment will put more money in your pocket, but rising Medicare costs will eat into that increase for many people. The earnings limits are going up, giving you slightly more flexibility to work if you choose to, and the substantial gainful activity thresholds for disability recipients are also increasing. These changes are all indexed to inflation and wage growth, so they happen every single year, but the specific amounts vary depending on economic conditions. By understanding exactly what's changing and how it affects your particular situation, you can make informed decisions about your finances, your healthcare coverage, and whether working makes sense for you. This isn't just about 1 year either. The patterns and trends we're seeing now will continue into the future. So the more you understand about how Social Security works, the better equipped you'll be to navigate whatever changes come next.